Did you know that the hotel average daily rate is your ticket to higher profitability? You're wondering how that can be. Stay until the end of this video where I will share with you visually how a higher average daily rate can contribute to higher profitability. Let's get into it. This is the market segment statement, which is part of the income statement of Paradise Hotel. In particular, it's focusing on average daily rate. We're going to be looking at average daily rate closely. This is the market segment statistics report, which is part of the income statement of the Paradise Hotel. Note a couple of important elements normally not found part of a hotel profit and loss statement. And that is these allocations of lean, standard, and peak months. You will see the significance of this very shortly. In an earlier video, we looked at how a hotel occupancy can be a lean month, a standard month, or a peak month. In this particular case, if you look at the month of February, the Paradise Hotel had an occupancy of 66%, while a standard month in the month of March, the occupancy has gone up to 81%. And in the month of April, considered a peak month, it jumps to 93%. Are these lean and standard and peak months the same for every hotel? Certainly not. There are many factors which play a part here. However, these are very important for us to understand today's topic, which is average daily rate. Take a look at the average daily rate of the Paradise Hotel for the 3 months. You can see that the lean month has an average daily rate of 241, which moves up to 246 in a standard month where the occupancy has also gone up. And finally, the average daily rate hits the highest during the peak month of April. The total occupancy percentage shown here and the average daily rate and their movement across 3 months of lean, standard, and peak occupancies are two common elements of the seasonality of a hotel. The hotel belongs to an industry which is seasonal. We saw earlier that the average daily rate moved from $241 in February through $246 in March and peaked at $250 in the month of April. But most important to realize how these were actually achieved, take a look at the 2 rows right below the average daily rate. They read individual average daily rate and a group average daily rate. Further, notice that the individual average daily rate, if you take February, is at $243, which is higher than the overall $241 just above. While the group average rate, which is at $229, is quite a bit below the overall hotel average daily rates. These are not uncommon in the hotel industry. In general, the 2 major market segments by which hotel average daily rates and even occupancies are measured are individual and group. So, what is an individual market segment? An individual market segment is somebody who travels alone or as a couple, either on business or on leisure. And important to understand that the individual is able to pay a higher room rate than the group. What is a group market segment? A group market segment is a group of individuals who travel together. In general, in the hotel industry, the average daily rates or the room rates are significantly lower than the individual average daily rate. That you can see right here. The group average daily rate in February is at 229 as opposed to 243 for the individual average daily rate. Both these individual average daily rate and the group average daily rate are the ones contributing to the total room revenue shown here. And you can see clearly that the individual room revenue is almost about 80% of the total room revenue, while the group room revenue is only about 15 to 20%. This is very common in the hotel industry. The group room revenue contribution is much lower than the individual one. This is the market segment statement which we saw earlier for Paradise Hotel and which is part of the income statement. In general, it is part of the income statement as a schedule and not part of the main income statement. Pay attention to the first three columns, which are February, March, and April. You saw them earlier where we noticed that the total individual average daily rate is $243 in February, as you can see here too. The group is at $229, as you can see here as well. And the average daily rate for the hotel was $241. So we saw earlier that the individual average daily rate is above the hotel average rate, while the total group average rate is lower. These are typical occurrences of market segment information in the hotel industry. Moreover, take a look at the individual market segments. The three major categories featured here are negotiated, transient, and direct. Negotiated are generally corporate contracts signed with major corporations, and so these are called negotiated rates. It also includes rate for crew members of airlines. Transient rates are rates which are very temporary, and as you can see, the three major categories are the best available rate, the walk-in rate, and packages. Packages tend to be used more in lean months than in other months. And the direct individual market segment is mainly incentives for booking, for rates, for loyalty programs, referrals made, etc. In the group market segment, you can see two major ones: meetings and incentives, and association and conventions. And then the other subcategory is the wholesale, which are generally travel agents or tour operators. This gives you a very capsuled look at how market segments operate in the hotel industry and how average daily rate in particular influences the total revenue. Welcome to the 25 financial terms beginner hotel managers must know. Let's now take a look at the phenomenon that I mentioned earlier in the video about how average daily rate increases result in higher profitability. This part of the video is about the average daily rate, your ticket to higher profitability. We begin with the premise, an important one at that every revenue increase does not really result in a profit increase. Did you know that? And why is that? This is because when revenue increases are only due to price increases. When I say price, I mean average daily rate. We shall see that shortly. The entire increase in that revenue travels to the profitability or to the bottom line. We'll see how that works visually in a bit. So we will be using a rooms department example to illustrate this principle. So revenue is contributed by quantity multiplied by price. So what is quantity? It is occupancy for the rooms department. And what is price? It's the average daily rate for the rooms department. So having said that, revenue increases due to an average daily rate increase only ultimately results in a profit increase. We will see this in a visual way. So let's take month 1 and month 2. Month 2 is the later month. So in this first scenario, we are assuming that the occupancy in month 1 and 2 are the same. Because the occupancy in the 2 months are the same, the variable costs are also the same. What are variable costs? Well, any costs related to an occupied room, like the guest amenities placed in the occupied guest rooms, any other variable expense are considered variable costs. The average daily rate, however, increases in month 2 compared to month 1. So again, to repeat, the occupancy is the same between the 2 months, but the average daily rate goes up in month 2. As a result, the room revenue increase that you see is actually only due to the average daily rate. And per this phenomenon, because it's an increase due to the average daily rate, that room revenue increase entirely goes to profit. Because when a rate increases, there are no variable expenses that go higher in month 2 compared to month 1. Now, take another scenario. If the revenue increases only due to occupancy, again, we use month 1 and 2 in our illustration. And here we are assuming that the average rates are the same. And the occupancy is the one that has gone up. Now, because the occupancy has gone up, along with it, you will have variable costs of an occupied room also going up. Now, when the room revenue increases, the increase in room revenue will go to the profitability or bottom line only after the increase in variable expenses is taken into account. Which means the moral of the story is, where a hotel's revenue increase is strictly only due to occupancy, the entire revenue increase will not go to profitability. You will have a lesser profitability increase due to the variable expenses which come with the increased occupancy. So you could state this whole principle this way. However, in reality, revenue increase is rarely only due to occupancy or average daily rate. This, however, does not take away by any stretch of imagination the powerful effect of a price increase due to average daily rate on profitability. The price profitability connection allows hotel managers to know the different effects of revenue increase on hotel profitability, one due to occupancy and the other higher due to average daily rate. If you liked this video, consider subscribing to the Profits Masterclass channel. For future videos in this series and others, straight to your inbox.